Three strong buy stocks that are too cheap to ignore. Now, going to the second half of the year, the market sentiment is growing clearer. First, there is a sense that the first half collapse may be bottoming out, or at least falling to a plateau and a pause before further drops. Second, there is a growing consensus that the recession is in the offing on a 1 year time frame, or possibly less. Now, a minority opinion holds that a true downturn is already on us, but we wouldn't know for certain until the second quarter growth numbers are released later this month. Now, what does this mean for investors? In the view of MKM Partners chief economist Michael Darter, the gloomy sentiments may have some upside. Darter sees it as an indicator that hard times are already getting baked into current conditions. He estimates that current prices are already 2/3 of the way to taking a recession into account. Now, putting this view into advice for investors, Darter says, our point here is that market have already priced in a significant risk of recession or earnings declines, and they may not be a recession this year. Even if it's a recession, markets moves first, and investors are highly unlikely to be able to time the bottom. Now, first up is Capri Holding, a fashion holding and retail company with a multinational reach. Now, Capri has over 1,200 retail locations, including both stand-alone stores and in-store boutiques. The company carries and sells a wide range of high-end brand items, including apparel, shoes, and accessories under the well-known names of Versace, Jimmy Choo, and Michael Kors. Now, Capri has also strong sales growth in recent months. And in the company's financial report for the fourth quarter of fiscal year 2022, the quarter ending on April 2, it showed a top-line result of $1.49 billion. This was up about 24% year over year, and per management was a company record. Now, gross margin also hit a company record at 64.1%. Capri's adjusted net income for the quarter was $152 million, or a 1.02 in diluted EPS. This was more than 2.5 times higher than the year-ago result. At the end of fiscal year 2022, Capri held more than $1.09 billion in inventory, an increase of almost 49% year over year, and in line with the company's stated goals of both holding more core inventories on a regular basis and receiving seasonal inventories earlier in this cycle. Now, Capri has an active share repurchase program, and the company bought back some 5.1 million shares during the quarter, spending some $300 million to do so. The company board has since revamped the repurchase program, replacing the remaining $500 million authorization with a new authorization of $1 billion over the next 2 years. Despite all this, Capri's shares price has been falling. The stock has lost approximately 34% so far this year. These steep losses have left the luxury retailer with a relatively low share price and put it in a position that drew the attention of five-star analyst Robert Durbel. In his note for Guggenheim, Durbel wrote, while the company is facing numerous near-term macro and global headwinds, we continue to see an opportunity for CPRI to generate $7 billion in revenue and 20% operating margin over the long term, trading at just 7.1 times our new fiscal year 2023 EPS estimate. We believe CPRI offers one of the cheapest and most attractive ways to invest in the ongoing but non-linear reopening of the global economy, with an expectation for higher demand of occasion-based categories of handbags, footwears, and apparel for social events, travel, and return to office. Now, this is hardly the only upbeat take on Capri from the Wall Street, as it's clear from the breakdown in the stock's 14 recent analyst reviews. This includes 12 buys against just 2 holds for a strong buy consensus rating. Now, the shares are selling for just $43.04 with an average price target of $73.21. They have a 7% for the year ahead. Now, the next on our list is ArcBest Corporation, ARCB. With the second stock on our list, we'll shift gears into the transportation sector. Now, ArcBest is another holding company, but this time in the transportation industry. Its subsidiaries are trucking firms working in the less than truckload LTL for short segment, a vital part of the shipping business. Now, LTL companies move freight loads that are too big for parcel shipping, but not big enough to completely fill a semi-trailer, and they move them on the full range of routes from long-haul interstate to urban last miles. Now, a quick look at some numbers tells us just how important the niche ArcBest feels. The company has over 80,000 active freight carriers, 14,000 employees, and brought in more than $4 billion in revenue in 2021. Of that, the company has invested more than $150 million into tech and innovation, especially focused on strategic projects. It all set ArcBest up for a solid start to 2022 with the first quarter revenues of $1.34 billion, a gain of 61% year over year. The high revenue pushed earnings up too. Net income for the first quarter of 2022 reached $79.8 million for diluted EPS of 3.08. Now, both the total revenue and the diluted EPS were the best in more than 2 years, and ArcBest gains were broad-based, reflected in all of the company's operating segment. Now, even so, ArcBest stock has lost 36% this year. What this comes down to is a stock that investors need to pay more attention to in the view of Credit Suisse analyst Ariel Rosa. Now, ARCB is the cheapest stock in our coverage. It has an attractive 12% free cash flow yield, the highest in our coverage. The company has demonstrated strong performance over the past few years, yet its current multiple reflects significant skepticism as to the sustainability of those results in our view. If it can sustain this result as demand normalizes, particularly an LTL operating ratio below 90%, it could see considerable upside to its share price, Rosa opined. Overall, the unanimous strong buy consensus rating of this stock, supported by 4 recent analyst review, makes it clear that Rosa is not alone in his bullish view. Now, the average price target here, $129.50, is even more optimistic, suggesting an upside of approximately 7% from the current trading price of $76.23. Now, the next one is Open Lending Corporation, LPRO. In recent years, the automotive sector has found important support from customers' financing, which has driven both new and used car sales as prices have increased. Looking forward, that support is only going to become more important, but also more complicated as interest rates rise. Our next stock here, Open Lending, dwells in this sector. The Texas-based company provides a range of services for financial institutions and lenders, particularly automated loan analytics, risk-based pricing and risk modeling, and automated decision technology for automotive lenders. Now, Open Lending operates throughout the U.S. and has been in business since 2013. The company went public in 2020 though. Now, since entering the public market, Open Lending's share rose fast to peak above $40. The stock stayed at or near that level through most of 2021, but in September of last year, it began to slip. Now, year-to-date, LPRO shares are down 57%. A look at the numbers here may help to explain Open Lending's share decline. The company is facing headwinds due to inflation, higher interest rate, both of which makes it more expensive for customers to purchase vehicles. Now, yet, the most recent quarter, that's the first quarter 2022, showed a top line of $50.1 million, which was up 13% year over year. Now, business remains strong in the first quarter, with the company certifying 43,944 loans compared to 33,318 in a year ago quarter, for a gain of almost 32%. Net income rose from $12.9 million on to $23.2 million, or more than 79% year over year. Now, in his note on Open Lending, JMP analyst Davis Karpf, who holds a 5-star rating, writes, the company delivered a very strong first quarter with both top and bottom line upside, as well as better than forecast loan certification volumes, certs for short. Furthermore, I believe is that the reiteration of the full year revenue, EBITDA, and cert guidance will be viewed positively in light of investor sentiment that was painting a more dire portrait of auto loan demand during 2020. We believe that the unprecedented supply chain headwinds that have weighed on dealer inventory and lending volumes, as well as the effect of credit normalization on carrier profit sharing, are priced into LPRO shares. All in all, out of 9 analysts who have weighed in on LPRO shares recently, 7 have rated it a buy, while only 2 rated it a hold. Given the stock a strong buying consensus rating, the average price target of $26.22 suggests an approximately 171% upside from the current share price of $9.69.